Okay, good morning everybody and welcome to Rebate's webinar on why CFOs and auditors need rebate management. I'm going to hand you straight over to Rebate's CEO and founder, Leanne Bonner-Cook. Thanks, Leanne.
Thank you very much, Caroline. Thank you all and welcome to our webinar this morning. Thank you all for taking the time out to join us. So today I'd like to go through some introductions. So I'm going to chair the event today, but I have a panel of really good experts here and I'd like to introduce you to them. So first of all, I have Barry Lee.
Hi, good morning everyone. My name is Barry Lee. I'm co-owner and director of Lee Business Advisory. We're a niche corporate advisory business working with owner-managed and family-owned businesses. And prior to that, I had almost 30 years in corporate banking and asset-based lending.
Thank you, Barry. Next, we have Catherine Kelly.
Hi everyone, I'm Catherine Kelly. As my introduction says, I'm head of retail and an audit partner at Cooper Parry. I also chair the ICW Retail Advisory Group.
And Ian Borley.
Yeah, good morning, everybody. I was until recently a partner at KPMG. I was senior partner of KPMG's East Midlands practice. I was an audit partner by day job, and in that capacity, audited a number of clients who were wrestling with the issues of rebates. I now run my own consultancy business.
And last but not least, Nick Eggert.
Hi, good morning everyone. Nick Eggert, I work for BDO as a supply chain logistics risk lead. I support clients in managing all things relating to their relationships with customer and suppliers involving procurement, contracts and relationship management.
Thank you very much all. So in terms of financial management, rebates are critical, both from a supplier and a buyer perspective. The challenges may be different, but they're equally important on both sides. At Rebate, we simplify the rebate process with our IRM model to help you get the most from your rebate deals. Using our IRM software, which is Intelligent Rebate Management, we do the magic to manage your rebate programs, driving informed decisions to optimize your profit margins and improve relationships across the supply chain. Today, we're just going to have a brief presentation and then jump straight into Q&As with our panel members. So today, CFOs are under great pressure to cut costs and grow revenues in light of finance operations. As a CFO, you care about the company's bottom line. It's the reason you get up in the mornings and no doubt what keeps you awake at night. In terms of a CFO, though, they're expected to play 4 key roles. A steward, which is about protecting and preserving vital assets of the company. The operator, operating a well-organized, results-driven financial organization that delivers key services to the business. A strategist, providing financial leadership and align businesses and financial strategy to shape the overall direction. And a catalyst, which is helping others in the business perform better. So it's quite a significant amount that you guys do. To really embody all of those roles at once, then the CFOs having a strong relationship with key finance and business issues to be able to deliver real insightful forecasting while managing revenues and margins. And overall, it's about the visibility of the numbers. It's crucial that CFOs must develop a strong working relationship and good communications, both internally across the supply chain and with auditors, because they both want to clear up to the minute visibility into all the workings behind the numbers. This ensures validity and legality of financial records. It provides valuable and accurate reports to support strategic development. So to do so, a clear and detailed, transparent audit trail that traces every single transaction right back to the original source at a granular level is absolutely paramount. And how rebates become risk factors in that model. So rebates are one of those areas that are notoriously difficult to audit, especially when it comes to accruals and forecasting. And even more so in the current economic climate, with both COVID and Brexit playing a key part. It makes trading conditions more challenging for both parties, and having the ability to model and reforecast a scenario plan is critical. Companies that mishandle rebates can quickly find themselves in big trouble. I'll just give you a couple of examples there. So Tesco's, as a for instance, was thrown into a crisis when it misbooked rebate payments from suppliers. This led to a £250 million overstatement of profits. Essentially, the retailer prematurely recognised rebate income and had to pay a £129 million fine to avoid financial prosecution from the FSA. But actually, whilst that in itself is bad enough, in that process, it saw £2 billion wiped from its share value. For suppliers, the challenges can come from making assumptions that a buyer has met certain conditions. For example, you're paying to be on a gondola end if you're in retail for your products to be used in a certain project. But actually, how do you actually check any of this or validate it? So without the visibility, margins could soon be eroded. Judgment is often then used to recognise commercial income. And auditors have stated that commercial income, so promotional monies, discounts, rebates received from suppliers recognised during the year are absolutely material to the income statement, yet amounts accrued are judgmental, which is quite a shocking discovery when some sectors, the rebate is the make or break of their business at the end of that financial year. Transparency in rebate agreements plus transactional based audits does give you improved revenue recognition. And so the problem comes from the fact that we come up with a strategy around our rebates, and whether that is to increase revenues through rebates. Our question should be why, and it's about delivering a win-win solution. Some people do see rebates as being an evil necessary that they have to perform, but if the strategy is right, then obviously the intention is to increase relationships and increase revenues as well. We then go off and we transact and buy and sell against the strategy that we've created. And then we execute, and that means the collection of the rebates. But what happens is all of these functions are quite siloed. And so when they're passed between one to the other, things can fall through the gaps. So some examples of that are, if I'm a procurement and a category manager, I'm going and negotiating a rebate, but I forget to pass that to finance, or it's updated part way out throughout the year, and I forget to tell finance that it's updated. Equally, it's having the visibility. If I'm a supplier and I've offered like a guaranteed rebate, and in trading conditions like today, clearly I don't want to be paying out on a guarantee where I've not got the business that I expected. So it's how do we recognise that quickly enough and be able to do something about it? And actually, if it's not managed properly and things are dropping through these silos, then what it actually leads to is a loss of revenues as opposed to the increase that you were expecting. So small errors can lead to big losses and big costs. We typically see that these things are managed on manual solutions like Excel spreadsheets or a combination of, and just a small error in a cell or a change in a rate can make a massive difference. But without checking that, having the approval and the workflow, that's when we start to see big errors. So the solution is really to bridge that gap of those silos and build the whole jigsaw end to end, giving you that full visibility of the solution. So a digitized solution automates that end-to-end process. It does lead to improved visibility across the whole process. It removes the silos and therefore preventing revenue leakage. The outcome is an increased revenue. A fully integrated solution coupled with behavioural and cultural changes within your organisation puts you in control of your rebate management process. All too often we hear both buyers and suppliers relying on each other to provide them with the information about what's owing and what's due. That linked all together obviously then starts to see revenue increase as our strategy first set out, giving you a fully integrated end-to-end solution. So that's all I'm going to talk about now, and I'm going to move now on to the panel for a Q&A around some of the topic areas. So we have got some questions that come in, and again, put questions into the chat as they come along. But I'm going to start off first of all asking a question to Barry, and the rest of the panel please join in. But what are the pitfalls of rebates relating to invoice financing or asset-based lending?
Wow, thank you. That's a huge question. Essentially, any accounts receivable based funding solution is a fiduciary relationship between the lender and the client, and any lender wants to avoid shocks. You know, that's the worst thing that can happen. By and large, a rebate is seen as a very kind of difficult aspect when you're looking at putting a receivables finance facility in, and you know, ideally, lenders would like to see rebates kind of under a kind of 10% of the receivable. The key thing is, because it's a fiduciary relationship, is all of the reserves to the financing facility are set based on the information that's received from the CFO. That information very often, you know, at the start of a facility is taken quite largely on trust. And as a facility gets up and running, then there are periodic audits that will be done by the invoice finance lender. And during these audits, you know, they will be very thorough. They'll track paper trails, they'll track contractual agreements, they'll make sure that the accruals are correct. I found very much in my career that more often than not, the systems that you were relying on were very almost Heath Robinson by nature. A lot of them are Excel, a lot of them are manually updated. And when you went in and did the audit, let's say that you had an available amount of 500, a million on the facility. When you audit it and you were reserving the 5% retro or volume rebate, when you actually looked at it, you were under reserved. And if you're under reserved almost overnight, the lender will increase that reserve. And as you can imagine, that has a huge impact on both the immediate and the forecast cash flow of the business. So from that viewpoint, it's absolutely critical, absolutely critical.
Thank you very much, Barry. Does anybody else from the panel want to add to that? So I think we'll move on to the next question then. So this is for Catherine. So Catherine, when large sums of income are being managed on spreadsheets, what are the biggest audit challenges?
Yeah, that is another good question. I mean, there's numerous audit challenges. I think Tesco really scared a lot of people about how badly wrong it can go. But even before that, yeah, it's definitely a dark art, I think, rebates. And it's always been something that's quite hard to shed the light on. The main challenge for me is that completeness. And it's whatever system they use, and majority of my clients who I work with, and these are very large companies in a lot of respects, still use Excel. And one challenge is, has the data even got onto Excel or into the finance team? Because it's often with buyers or people in the procurement team, people may have moved on, it might be held in email. So that's the first challenge of, have we even got the full sight of everything that's there? And then if we have got the sight of it, have we correctly identified all the terms, the conditions, because contracts may change? I think, Leanne, you mentioned some of the more quantitative and qualitative elements of, you know, is it in a prominent position? Is it on a gondola end? Was it in this number of stores for these periods? That's really hard to prove retrospectively. And often these Excel spreadsheets who are set up by finance don't even have fields for these kind of categories. So again, that's a real challenge. Timing is another issue. Is it recognised in the right period? That was previously easier when companies could more accurately forecast their inputs. If you sold toilet rolls, I don't know, let's scrap that. That's a bad example. They're not having. If you sold soft drinks, you could relatively easily know how many soft drinks you generally sell in your store or in your petrol station. Whereas now with COVID, all of that's up in the air as well. You don't necessarily know how many you're selling. You might not have the same footfall, or you might not have the same stores open. So that then leads into the forecast, which then leads into the timing of whether you either are eligible for the rebate and when you should reflect it. So yeah, there's lots and lots of difficulties around the data itself before you even go into the fact that ultimately often it is a spreadsheet, and then you have formula errors or typos and issues around that. So yeah, it's a headache, definitely.
Thank you very much, Catherine.
As Catherine, sorry. I was just going to say, as Catherine says, rebate, the nature of rebates, as everybody knows, I mean, they tend to change year by year, season by season even, and you quite often find that spreadsheets have evolved over many years and many seasons to take into account all of those weird and wonderful arrangements that buying teams have entered into with salespeople. And those are reflected in spreadsheets that just grow like topsy in my experience, and something that was relatively straightforward in year one, by the time you get to year 5 is expanded to column CX or something and down to row 2842. And those cumbersome spreadsheets are very difficult to get your head around and indeed to control. There are very few access controls, obviously, as we know, to Excel spreadsheets, for example, and it's very easy for somebody, whether it's from finance or from the commercial side of the business, to make a change to a cell somewhere within that spreadsheet that then in subsequent years gets copied across or down in error. And you said earlier on, Leanne, you know, small errors can magnify into big misstatements, and I've certainly seen that on a number of occasions. So they're quite difficult things, I think, to control, particularly over a period of time and with a number of users.
Yeah, and I think it's also worth sort of considering as well who is the architect of the spreadsheet, because often you've got the one person who's a ninja at Visual Basic or macros or pivots or whatever it is, and they will have created the spreadsheet, and if that person goes, do people understand how it's constructed, having sort of considered what's just been described as the expansion of the spreadsheet. I think there's an element about contract and contract changes, reflecting those. In my experience, management of contracts is not well done in a lot of organizations, to the extent when you think about, I've done a lot of payment practice reporting work with clients, and I ask how many contracts or suppliers they've got, and that they don't really know to any degree of accuracy. So there's that element, but also I think as well, Excel, even if you do have systems, are you using Excel to move data between systems? Is there a lack of integration? And anything where you do have Excel, as the guys have said, there is an element or a risk that you're going to introduce error. And introducing error in spreadsheets it's expected in modelling and all kinds of things. It's one of three certainties in life, along with death and taxes.
Thank you very much, all. So the next question then is, what is the impact of rebates on cash flow? Barry, do you want to take that?
Yeah. Again, coming at it from my own particular specialism, the way it's going to impact on cash flow from my kind of experience is just how it would impact on a funding facility. So from that viewpoint, timing is very critical. Making sure that the funder mirrors the reserves that accurately reflect the CFO or the FD's accrual. I think it's easy to say, it kind of from an invoice finance viewpoint, that it's kind of has a negative impact. Well, it doesn't, because if it's managed well and it's managed accurately, it actually allows you to enjoy this kind of funding facility. Because if you go back historically, not so many years ago, potential clients to use receivables finance that had any form of rebate were almost kind of like put to the bottom of the line and seen as very difficult, because there was a lot of case studies that lenders had, that when the facility was audited, the errors were just huge, and it just was a risk too far. I kind of like what Nick said. I think at the end of the day, there's a lot of focus on the here and now, and what is kind of going through what's the numbers, what's the historical rebates been over the last 12 months, what's the impact, can we reserve accurately, are the mechanics right, is it a credit note, is it a debit note, is it self-bill? If we can measure that, that's fine. And in that respect, if you can do that, then it actually improves the cash flow, because it allows you to have enjoy these sorts of facilities. Like everything, the issues are when it's either subject to error, in which case, well, look, there's not a lot you can do with that, and you have to really check through the systems, and again, using my words very carefully, where it's subject to manipulation. Because very often you can enter into these kind of relationships where you're advised that the only kind of rebates will have a 2.5%, no more than that, and fine, and here's our reserves to show it. But when you actually go through it and do your kind of second or third audit, and you actually go revisit the contract, you'll find the contract's changed, the nature of the rebates changed, and whilst you might be looking at a 2.5% headline reserve, it could have shot up anything as high as 5, 7.5 and upwards. So from that viewpoint, it is a negative impact. So from that viewpoint, yeah, it is far-reaching and far-ranging. There are a lot of hidden rebates in there that very often you don't get to see until you dig under the surface. So from that viewpoint, again, it can have a negative impact. But ultimately, as I said at the start of my kind of overview here, it's invoice finance is a fiduciary relationship. It's based on trust. So a lot of it's down to being able to believe that the judgmental part and the interpretation part of it, has some kind of integrity to it. I have also previously in my time come across what we termed a prebate. It's only happened once. And again, the kind of scenario was, Mr. Supplier supplies customer. Customer kind of would say, right, well, we want a prebate, often quite a large amount, that we'll take on day one of the contract with you, and that will unwind over a period. And again, in this particular situation, when I was faced with this, we got comfortable with actually allowing that, and it was a large prebate. So the danger being, obviously, the danger is set off clearly. If you've got X amount out against the receivables ledger, but when you look at it, there are dilutions that will go against that. And there's hundreds of dilutions, but for today we're focusing on rebates. If that isn't accurate, you've got a problem. In this case, we're happy to do that. We didn't actually set a reserve to the facility, and in this particular situation, the amount of the prebate was million plus. We were able to do that because we'd audited the systems. We believed in integrity. We liked the financial strength of the organisation. It allowed them to take on that contract in a way that they wouldn't have been able to do otherwise from a working capital viewpoint. And we took a view that we go with it. When it got to month kind of 12 or 13, it evened out, and then it went back into our favour, if you like. So, like everything, the main impact is positive because it allows you to take these working capital facilities on against your receivables. Where the impact is negative is if there's inaccuracy or manipulation.
Yep.
Leanne, I've a practical example of how it impacts your cash flow right now that I think others might experience. When we're doing the actual cash flow forecast and looking at them from a going concern perspective, I've got a retailer that is very reliant on their rebates because margins are so tight, yet often it's a negotiation and it's often linked to the relative power of the retailer versus the supplier or vice versa, that there's a lot of stalling tactics, shall we say. There's a lot of agreeing it from either side. They might want to bring in their own, there's a whole range of firms that make a living out of this kind of rebate auditors in a way. And it can often be a year or more before some of these are agreed and decided. So when you're looking at that cash flow forecast and you are due millions of pounds in some cases, to actually identify when those funds will flow in is a real challenge. And it's something that we have to be quite prudent about and also fairly skeptical about in some ways, that it's certainly not cash that we can say with any certainty we will get in this month, because we know the hoops that often you have to jump through, and that's more of a commercial or a negotiation position than it is a factual rebate position. But where the client does have good evidence to back up that rebate claim, it all moves more smoothly naturally. But that's one challenge we have found.
Yeah, it's the protracted
I think
negotiation that goes on with that that elongates the timescale. So absolutely.
Definitely. Yeah.
And I think, Leanne, that is even more difficult for the supplier in these relationships, to that whole level of predictability. Often the rebate agreement will be coterminous with the customer's year end, but obviously not necessarily with the suppliers. So at their year end accounts, they're making all sorts of guesses and estimates in terms of how much they are likely to sell during that rebate period. And these amounts are quite lumpy as well. So quite often these are calculated on a quarterly or possibly even an annual basis. And Barry talked about this earlier on. The customer will usually take that rebate as a deduction from a remittance to the supplier, and that can be a chunky amount of money. And I've often seen the case that where there's a dispute or a disagreement over the rebate, the customer will just keep the money until every single dispute is dealt with. So you might have a disagreement over £2.50, but there could be a remittance for £1 million that's not released as a result. And that for the supplier is a massive hole in their cash flow that people like Barry would get very excited about, but obviously causes all sorts of problems from an operational point of view and from an auditor point of view in terms of going concern that Catherine talked about as well. So I think from a supplier perspective, this is a really difficult area.
Okay, thank you. It's interesting. And just another question that's come from the floor. I mean, given that there are so many issues with current accounting for rebate processes, particularly with the use of Excel, why haven't more large companies identified and implemented better solutions?
In my experience, it's to do with the culture at the top. I think anything to do with IT and software, if it's seen as an IT issue or a software or a tech issue, it's way down the priority list. Whereas if it's a more progressive company that sees rebates as integral to their margin and their operations, and the better management of that is critical, then it gets the buy-in. So, and that's the same across things other than rebates too. I think wherever they're siloed into these being a tech solution, it never will get high enough up the agenda. But I think that's part of the issue. The other issue I've seen is that some of these large companies have very large softwares, SAP, Oracle, and the rebates element to it are very expensive, very clunky, will take a lot of implementation, might still not be right for the job. So I think having something a bit more agile is useful.
Yeah, I think also it's worth sort of considering the structures, how the organisation is functioning. Do you have a shared service centre doing your finance and that kind of stuff? Do you is it third party provided? Is it a shared service centre within your organisation? Do you have decentralised functions that are looking for business units? Do they all have the same issues? How are finance linked in with sales, linked in with marketing, linked in with procurement? So there's a few issues there, but also no organisation wants to present rubbish information to their executive or the senior management. So I think there's an element of what is being presented. The organisation is probably working really hard, if it understands there is an issue, working really hard to present the best information to the organisation hierarchy. And so there is no acknowledgement that there is a drama or there is an issue to be resolved. And I think, as Catherine said, that's not just in relation to rebates, that's across every aspect of financial reporting and accounting, I would say.
Okay, thank you. And when there is no audit trail associated with transactions in solutions like Excel, what is the inherent risk that brings with it?
It's huge. It is huge, because then you're then reliant on building up a case in a way, building up a layer of evidence. And it's very challenging there where it's so judgmental, as we talked about some of the other aspects to it, where you're relying even not on financials, you might need CCTV or photographic evidence or mystery shopper evidence. Ultimately, what it often means is that companies then have to bring in experts. So they might bring in rebate auditors and people like that who make a really good living out of this, but do take their cut. So they will take a good chunk of that rebate that they can then support. So yeah, it is a real challenge where the audit evidence is light.
And that's quite interesting as well, Catherine, where people bring in third parties to do that review. I mean, how easy is that review, or how successful are they really when there's a lack of transparentness of the information and the data due to the reasons that we've spoken about earlier?
Yeah, it is very difficult. I don't know all of the kind of methods they use. I think Nick might have some more insight here he can possibly add, but yeah, they'll be using data analytics, they might be trawling through emails, but it's a very long, protracted process. And again, that's where I think you get into this judgmental element and this negotiation element, where you often see it where, I don't know, a retailer might claim for 4 million and then the actual amount settled on is 2.5 million, and that's a really big variance in the middle of how you've got from one figure to the other. And it's often due to audit evidence and what you can prove.
It's huge, isn't it? And again, you know, those figures, when we're talking about numbers like that, big impact to the bottom line of an organisation.
Yeah.
I think also, you know, it leads to all sorts of issues for the company. I mean, you know, clearly, if you've got no audit trail, you're relying on numbers here for financial reporting, for pricing decisions, for analysis of things like profitability and customer profitability. If your audit trail is missing or incomplete, then you could find that all of those things are thrown out.
I think you might have lost you there, Ian.
I think I'd like to just pick up on one point I made that I think Ian raised earlier, which is really fundamental to everything. That word dispute. A dispute over a timing and an amount and a value of a rebate, obviously, is very important. Certainly, but from my experience, anything that comes up in a dispute, that's something as small as that, as Ian said, can often mean that the whole receivable account isn't paid. So it really does have a massive impact on an FD's ability to accurately predict cash flow moving forwards. And I think that's often missed, that rebates seem, well, it's it's a 2.5%, it's a 5%, whatever it might be. Obviously the accrual, the timing, the nature, the frequency, but it's what it actually does to the rest of that receivable.
I think the other things as well are.
It's gone again. Is he there?
I think we keep losing.
Yeah. I think also that the audit trail, I think there's when we talk about audit trail, we talk about organized information and data that's easily searched, and I think sort of this feeds back to one of your original points, Leanne, is that we often work in silos. You've got salespeople and commercial directors keeping information agreements in their inboxes or in their personal drives on whatever shared area they've got. You've got processes that the finance team are following that perhaps aren't known about, and so I did a review with a food manufacturer some months ago about their shared service center, and there was, they're not doing this, we're not doing that, or they're not providing the right information. But actually, when you sat down and talked to everyone, they were all hoarding their information. So I think it's about organisation and management. And these third parties, again, you're entering into another agreement. You've got another contract. You've got another cost there that you may create a dispute in. But all they do is look through the information that other people don't have the time, and it's often a timing, having the time to do that, to look through the information, and again, looking at contracts. Are the contracts that you've let, do they specify what audit and information you should store and how you should store it and how often it should be shared? Because that's often something we see in contracts where those terms aren't included, or where they are included not followed. But if they are included and are followed, then you've got a starting point to at least give yourself a chance of responding well to any claims that occur.
I think you're absolutely right, Nick. It always amazes me in some degrees. Some of the larger corporates that we were fortunate to deal with, how kind of like influenced the communication channels are, and very often, what is a significant part of a business finances impact on several other areas, but very much the domain of one individual almost kind of held it to themselves and didn't really want to share any data. It was seen as I know, something very secret and very dark art. And for me, it never ceases to amaze me how a CEO or a COO would go out in the field and agree some amendment or some change to a key rebate mechanism, and very often, it wouldn't be communicated back to the finance function, possibly at all, until the first kind of like instance of that came through into the billing sequence, or was communicated later, or it was in the kind of next contract that came through. And then that meant, as you say, a spreadsheet had to be amended. It was only that one individual who could amend that spreadsheet. So everybody else was acting in a bona fide nature and doing what they thought. But before you knew it, you had this huge changed figure that, from my point of view, impacted on the cash flow that they could have. And I always used to sit and think, well, this has to be, there's got to be a way with some of the sophisticated financial systems that they were running, some of the real kind of market leaders, some of the packages, that this can be automated. But it just never seemed to be. It always seemed to be that the rebate was run behind a system on a spreadsheet managed by the CFO. And you're thinking, this is just mad. I can't understand how you would do this. It's so critical.
It's interesting, isn't it? We see that quite often. Those disjoint. And I think it's because the objectives of the functions are very different. So if you're in a commercial team or a buying team, you're negotiating the best deal for the company, but then it's handed over to finance just to collect, without any real understanding potentially of the business or the rationale behind it as well. I think that siloed way of thinking and operating. It's like literally we've done the strategy, we've created the agreements, and we just throw it over the bench for collection and don't really care about it after that at that point on. So again, by having that visibility and near to real time, being able to see and then make better informed decisions based on that data that you physically got.
Undoubtedly, yeah.
Okay, and just another question then that we have. So a survey of Deloitte showed that 40% of financial leaders don't trust their financials. So what can we do to improve this?
I think culture, we've touched upon that from what Barry just said, but culture is a massive point, I think, of getting everyone in the business bought in to the financials, why they're so critically important, what they lead to, and whatever you're doing, whether it be implementing a rebate system or whatever it might be, educating everybody in the business and having perhaps training or sessions that relate it back to them and why it's important to them. This might also be linked to their rewards or their appraisals or whatever it might be, but that's a massive part of it for me, that you're trusting information where you are critical that the rest of the organization give you that information, and they might not either know why you need it or be incentivized to give it you.
Yeah, I think there's also an element of whenever we're producing information for consumption by other people, we know the process by which it has been produced, and some of that will be based on hard facts, some of that will be based on reference, some of that will be based on assumptions. And I think being able to understand the root of that information, where it's come from, where judgment has been applied, where assumptions have been used, that would be useful as well. As part of that development, and sort of, I suppose, drilling down a little bit to the points Catherine's just made. Often we get presented. In a previous life, I worked in the army, and we discussed how a few PowerPoint slides produced by a couple of mid-level sort of staff were briefed into the hierarchy, became fact, and were talked about in that way. Nobody questioned it. We did our best, but that was based on a perception. So I think that's the same. But if you don't have the provenance for that information, then that you start becoming. You start coming into your biases, your unconscious bias. Do you trust the people who are producing it? Do you have faith in that particular sort of director or department? And so there's an awful lot of sort of cultural, systemic challenges about producing it. But I think if you can, demonstrate where that information has come from and that data has come from and how it's been developed, then you've got a chance of developing some trust and challenging it and adjusting it so that you do have faith in it.
And this is an area that CEOs and CFOs really need to take an interest in, because in my experience, this is an area, if not well controlled, is an area that's susceptible to fraud. Fraud risk is really high. It's very, very easy for rebates, payments or receivables to be mismanaged with a little bit of collusion. And also, it's an area that if you get this wrong, and you constantly get it wrong, when you come to sell your business or raise finance, it's an area that will get found out on due diligence, for sure. And people will then use that as a price chip in terms of the valuation of your business. So this isn't a question of just getting your year-end accounts right. I think it's absolutely fundamental in terms of the way the business operates, the way that you price. your relationship with customers or suppliers, depending which way around it is, and ultimately the value of your business, as Tesco's demonstrated.
Yeah, good points, Ian. And I absolutely think that, yeah, it's true. And I think on the surface, one of the issues that we come across quite often is inertia, and that the Excel spreadsheet is fine, and we are managing it, and we can see the figures on there. And whilst in a lot of cases, that they do trust the figures, and the spreadsheet's been built up over a long period of time. We do say that there are errors, and because you can't audit it, you don't know why a change was made, who made the change. So again, in terms of audit, when terms are changing on contracts or rates are changing, and you're going back into the Excel spreadsheet, making those changes, I think again, that's where the tool is great, isn't it, Excel, but it does have its place. And and those risks around not being able to audit who made the changes, when the changes were made, etc., and these complex workbooks that have been built over a number of years, also add to those challenges. And then it's very difficult to be able to foresee those.
I think Ian's point's really good as well, because increasingly in any relationship, be it a commercial relationship, be it a relationship with your funder, there is now a wider acceptance of the due diligence process at whatever stage it is. It doesn't necessarily have to be part of looking at my current kind of life of a transaction. As Ian said, it's a key part of it. It can lead to a pretty significant price chip. But I think increasingly, the historic kind of for me, you seem to have a very strategic CFO. You could have a very numbers-driven CFO. Increasingly, those characters are becoming more hybrid now. And from a lender's viewpoint, there is far more propensity, if they feel the need, to bring in an external audit function. So not the actual statutory audit function themselves, but if they're looking at their collateral base, and they feel that obviously, it's an important client for them. So they've tried to have a very relationship management approach when they put their internal auditors in and their internal client managers. There is no hesitation now. If they feel that, there is something slightly off, they will bring an external firm in to boost up their due diligence process. So look, having been in that industry for many years, historically, as Ian said, situations could be manipulated over a period where you had a very relationship-based relationship with the auditor who came in. It was very often the same auditor, it was the same client manager, a relationship with a very commercial bias developed. But increasingly now, there'll be no hesitation to put an external specialist firm in there. So I think when you are looking at this, if I'm looking at it now, I was back in that sector, and I was looking at how we looked at the clients we provided funding to, then you've got to be at all stages of the belief that you have to get it right, because there isn't a situation where you can manage it on a relationship basis now. There will be external DD brought in at a drop of a hat. So it is absolutely critical.
That's great. Thank you very much. I'm just conscious that we've probably got about 2 or 3 minutes to go. So really just to summarise and wrap up, thank you for joining me today. There were some real key points coming out of the discussion. So, we did talk about the CFO information and trust in terms of facilities for finance lending facilities, and how those relationships were critical to be able to do that. We talked about audit challenges and completeness using Excel spreadsheets. So things around capturing contract conditions, the timings, volume tracking, and the ability to forecast. Also the formula errors, changes year on year, seasonal changes, so year-end changes between buyers and suppliers not meeting up, so impacts on cash flow. We talked about organisation structures and people recognising that there was an issue to be resolved. And that brought us on to culture, really, where we said culture, it's the what's in it for me, trusting the info and knowing the why. But also it's about that unconscious bias and trusting those relationships that we've got in place. So I think that there were also really good points coming out. We talked about no audit, and that's about building the layer of evidence, the amount of money then spent on third-party companies to review and try and piece this together, and not having the correct audit trail, but reporting on these figures that are potentially missing or incomplete, and the effects that they can have on businesses. We also covered off about silo processes and how there isn't that transparency between the two functions, and that really they do work in isolation. Also, top picked was if not controlled well, then they are subject to fraud, which obviously if you get that wrong, that could be detrimental to your business. But also if you're ever looking to sell the business or looking at finance obligations, then obviously that could have a massive effect on valuation. So I think there's been some great points come out of there today from the panel, and I'd like to thank you all for joining me today. What we will do is circulate a copy of the presentation in our ebook on why CFOs and auditors need rebate management, and so we'll do that straight after the show. And the contact details today will be in the presentation of the presenters that took place today. But I would like to thank you all very much for attending and listening. I hope you got something out of it, and feel free to reach out for any further information or questions that you have. We have had some additional questions which we will put on through social media and get the panel to ask those questions. So follow Rebate on LinkedIn, and we'll post them on there over the coming week. But many thanks to everybody for joining me, and thank you very much, panel.
Thank you.
Thank you.
Thanks very much.
Thank you.